What's up, everybody? My name is Ryan, and today I want to talk about whether or not rental properties can actually reduce your taxes. So there's this common misconception that I get from a lot of people that, if you have a lot of income, you should just buy a rental property because it will then reduce your taxable income and thus reduce your taxes. Well, that's actually particularly not true in a lot of scenarios, and I'll go over that here in a little bit. But I did want to go over the reality first. So the reality is a rental property or any type of real estate that you buy as an investment is a capital asset. That means that you can't just write off the entire cost of the property all in one swoop. It has to be depreciated over time. And if we're going to talk about rental properties, those are depreciated over 27 and a half years. Okay? So let's say you go out and you buy a property for $500,000. That means you cannot just take a $500,000 deduction on your tax return. You need to take that $500,000 and divide it by 27 and a half years. And each of those years, that is your tax deduction. Now that's typically, I think, what people really are thinking about when they're thinking about buying property to offset your taxes. And yeah, that might be a reasonable sentiment, but there's also one other thing that you need to overcome, and that is the passive activity loss rules. So when you have a rental property, for most people, it's considered a passive activity income or loss. And if it's a passive activity, then your losses can be severely limited to completely unavailable. This means that if your rental property nets a negative income or a negative loss, then that loss can't be used to offset your other sources of income. So if you have like a W-2, or you own another business, your rental losses may not be able to offset those other sources of income, or if they can, it would be very limited. How limited? Well, passive activity losses are limited to $25,000 of net loss, and that's only up to $100,000 of AGI. And starting at $100,000, those losses are then starting to phase out, and they phase out completely when you reach $150,000 of AGI. So if you make more than $150,000 and you have net rental losses, you can't use those losses to offset any income. So don't worry though, those losses don't just disappear. They get stored away on Form 8582 passive activity loss limitations, and they can be used later when you are able to use them. But just if you're in any year where you're making over $150,000, those losses will not be able to be used. So how do you overcome this passive activity loss limitation? Well, there's a few ways you can do this, and I'll go over them right now. So first is, if you're a real estate professional, passive activity in real estate does not apply to you. This means that you are participating in real estate as mostly your primary source of income, and you work in real estate for at least 750 hours a year. If both of these conditions are met, then any rental activity can be treated as non-passive activity. That means that all your rental losses can be deducted against your other income, and no real estate activity is then deemed as passive, and there won't be any limitations. The next step down from that is called material participation. This is defined by the IRS if you meet one of 7 guidelines for material participation. I'm not going to go through each of these right now, but really it ranges from participating in real estate from 100 hours to 500 hours, and each of these have certain guidelines to them. So for example, if you pick, I think it was the 3rd guideline, where you participate for at least 100 hours in real estate, that activity has to be more than any other person that is working in your real estate business works on real estate. So what does that mean? That means if you hire a management company to manage your rentals, you have to work in real estate more than they do. That means you have to do more significant activity than looking for renters, fixing up the rentals, maintaining the rentals. All of that needs to be done yourself in more hours than your management company does. And that's the lowest criteria, is 100 hours. They go up to 500 hours of participation, and if you participate in real estate for more than 500 hours, then you get to treat real estate as a non-passive activity. But really, I'll include a link in the description below to kind of help you see what the 7 guidelines are to be able to treat rental real estate as a non-passive activity. Now you see here, it's not quite as simple as just buying property and then getting a tax deduction. There's these hurdles and challenges to overcome. But even if you do overcome the material participation tests and you overcome the passive activity loss limitations, you still got to figure out, okay, what actual deductions can you take to lower your taxable income, okay? Because if you were going to use depreciation, well, you can't start depreciating your property until it's available for market and or rented out. So you can't just take depreciation each year and not rent out the property. That means that you're violating the IRS rules for depreciation. And depreciation isn't really that much if you compare it to like how much rental activity or how much rental income you can get from the property. So really, depreciation will probably offset rental income, which then leaves you with still not really a big net loss to deduct against your other sources of income. So the most common thing that people look at then is something called a cost segregation study. So a cost segregation study is a way for you to accelerate the depreciation on your rental property. So like I said before, residential real estate gets depreciated over 27.5 years, right? So if you were to do a cost segregation study, what that would do is it would break down your rental property into different types of assets, and some of it can be depreciated over 3 years, or some over 5 and 7 years, and even 15 years. So what it's doing is it's accelerating the rate of depreciation. And on top of that, you get bonus depreciation rules, which means that these 3, 5, 7, and 15-year property can then be bonus depreciated, even further accelerating your depreciation in the first year of purchase. To sum it up, obviously, simply buying rental real estate will not give you a tax deduction. What it could do, in fact, is give you some rental income, right? So then you'll be making more money. It's an investment, and you're gaining appreciation on the property, hopefully. And as a side note to that, if you're earning rental income and you're depreciating the property on the tax return, you potentially could be making money without actually reporting a net income on your tax return, because your rental income might be offset by the depreciation and the mortgage interest. So something to consider there, and I hope this clears some things up for you, that real estate does not simply offset your taxable income, but it could be used in certain ways that could, further your investment portfolio. If you do some things right, you can set up strategies to then have some more deductions to offset your other income. That's all I got for today. Thanks for joining me. If you liked this video, please give it a like. And if you're new here, please consider subscribing to my channel. I'd really appreciate it. And if you think somebody will find this useful, please share it with them. All right? Well, I'll see you next time. Have a good one. Take care.
They act like they know. Guess I gotta hit them with an update. Okay. I been getting to it when I'm up late. Hit it when you at the front gate. They act like they know. Hold up. Guess I gotta hit them with the update. Really with it, I ain't got a pump fake. Killer flow and hit them with the one take. Act like they know. Guess I gotta hit them with the update. Okay. I been getting to